Welcome to our channel, where we explore financial topics that shape the future of our world. In today's video, we're going to dive into the concept of sustainable finance and the growing importance of ESG considerations. If you're new to this space or just curious about how money and sustainability intersect, this is the perfect starting point. So let's begin. Sustainable finance is a powerful idea that's transforming the way businesses, governments, and investors think about money. At its core, sustainable finance means using financial resources in a way that supports environmental, social, and economic sustainability over the long term. It's not just about making profits anymore. It's also about making a positive impact on the planet and people's lives. One of the key drivers of sustainable finance is the increasing awareness of global challenges such as climate change, social inequality, and environmental degradation. Investors are beginning to realize that ignoring these risks could have serious consequences, not only for society but also for their portfolios. For example, investing in a company that contributes heavily to pollution might bring short-term profits, but it could face regulatory fines, reputational damage, or even collapse in value over time. This is where ESG considerations come in. ESG stands for environmental, social, and governance. These three factors are used by investors and analysts to assess how sustainable and ethical a company is. Each part of ESG plays a unique role in evaluating risk and opportunity. Environmental factors look at how a company interacts with the natural world. This includes things like energy consumption, carbon emissions, water usage, waste management, and how well a company is prepared to deal with climate-related risks. Companies that invest in clean technologies and reduce their environmental footprint are often viewed as better long-term investments because they are more adaptable and less likely to face penalties or public backlash. The social aspect of ESG focuses on how a company manages relationships with people. This includes employees, customers, suppliers, and the communities where it operates. Key considerations include labor practices, workplace safety, diversity and inclusion, human rights, and customer satisfaction. A company that treats its employees fairly and engages with its community in a meaningful way can build trust, improve productivity, and enhance brand loyalty. Governance refers to how a company is run. It covers topics such as board structure, executive pay, transparency, shareholder rights, and ethical business practices. Strong governance ensures that a company is managed effectively and responsibly, reducing the risk of scandals, fraud, or mismanagement. Investors often prefer companies with strong governance because they are more likely to act in the best interest of stakeholders. In recent years, ESG investing has gained significant momentum. More and more institutional investors, asset managers, and even retail investors are considering ESG factors when making investment decisions. It's not just a trend, it's a shift in mindset. People want to invest in companies that align with their values and contribute to a better world. In fact, some studies have shown that ESG-focused investments can deliver competitive or even superior financial returns over the long run. Governments and regulators around the world are also taking notice. In many countries, there are new laws and reporting requirements that encourage companies to disclose their ESG practices. This helps create a level playing field and gives investors better information to make informed choices. In the European Union, for example, the Sustainable Finance Disclosure Regulation requires financial market participants to report on how they integrate ESG risks into their investment processes. This level of transparency is a big step forward for sustainable finance. One of the challenges, however, is the lack of standardization in ESG metrics and reporting. Different rating agencies and data providers use different methodologies, which can lead to inconsistent results. A company might get a high ESG rating from one provider and a low rating from another. This makes it harder for investors to compare and trust the data. That's why there's a growing push for global standards and harmonized frameworks that can bring more clarity and credibility to ESG evaluations. Another concern is greenwashing, where companies exaggerate or falsely claim their products, services, or operations are environmentally friendly. This can mislead investors and damage trust in sustainable finance. To combat this, regulators are tightening rules around sustainability claims, and investors are becoming more vigilant in verifying the authenticity of ESG disclosures. Despite these challenges, the momentum behind sustainable finance is strong. Financial institutions are launching new ESG-themed funds, green bonds, and sustainability-linked loans. Banks are offering incentives to clients who meet certain ESG criteria, and private equity firms are integrating sustainability into their investment strategies. This shows that sustainable finance is not just about doing good, it's also about managing risks and seizing new opportunities in a changing world. Technology also plays a crucial role in advancing sustainable finance. Big data, artificial intelligence, and blockchain are helping to improve ESG analysis, track sustainability metrics, and enhance transparency. These tools make it easier for investors to monitor performance, identify red flags, and make data-driven decisions. As the demand for ESG data grows, the role of technology will only become more important. There is also a cultural shift underway, especially among younger generations. Millennials and Gen Z are more likely to care about sustainability, social justice, and ethical business practices. They want to work for companies that share their values and invest in causes they believe in. This generational change is influencing corporate behavior, as companies adapt to attract both talent and capital. Looking ahead, sustainable finance is expected to become an integral part of the global financial system. As climate risks become more urgent and social expectations continue to evolve, the integration of ESG into financial decision-making will no longer be optional. It will be essential for long-term success. Sustainable finance is not just a concept. It's a movement toward a more responsible and inclusive financial system. By considering environmental, social, and governance factors, we can make better choices that not only generate returns but also create a positive impact. Whether you are an investor, a business owner, or simply someone interested in the future of finance, understanding ESG is a crucial step toward building a more sustainable world. Thank you for watching. If you found this video helpful, please support our channel by subscribing, liking, and sharing. Your engagement helps us reach more people and create more meaningful content. Stay tuned for more insights on finance, sustainability, and the future of our economy.